Welcome to Fun with Us, the Crazy Trio.
I'm Tharanya.
I'm JingZhi.
And I'm Narita, and today we'll be talking about the units of activity method,
which is one of the three ways the accountants use to calculate depreciation.
We're gonna have so much fun because learning is so much fun. So stick with us through this fantastic lesson and make sure you take notes.
Yes, take notes.
Yeah.
Hashtag
blessed.
Okay, so the first thing we're gonna talk about today is the definition. What is the definition of units of activity? Units of activity, also known as the units of production method, a depreciation procedure that calculates depreciation on a basis of expected output of usage. It is useful when the property's value is more closely related to the number of units of what it produces than a number of years it is in use. In other words, it is the depreciation of an asset based on the number of units it produces, rather than the numbers of years of useful life left. Useful life depends on its productivity and the ability to produce the total number. This method may be appreciated when there is a high correlation between activity of an asset and its physical wear and tear. So the second thing Narita's going to discuss with you guys is
how to calculate depreciation using the units of activity method. So the formula is as follows: cost of fixed assets minus residual value divided by estimated total production altogether times actual production. So what is residual value? As you should know, residual value is how much a fixed asset is worth at the end of its useful life. This method is usually used primarily in a manufacturing environment because it calculates depreciation based on the number of units produced in a year. The useful life of assets depends on its productivity and ability to produce the total number of units. Companies stop calculating depreciation when the net book value of an asset is equal to the residual value at the end of its useful life. The depreciation expense varies on how much activity occurs per year. Other formulas that you could use to calculate depreciation under this method is number of units produced divided by life in number of units times cost minus salvage value, or cost minus salvage value times this year's activity. However, I would suggest using the first formula just to be sure.
Joke break!
Joke break!
Joke break!
Joke!
Break.
So guys, I have a funny joke for you. It's so funny. Okay? Ready?
Yeah.
Are you guys ready?
Yeah.
Ready.
Why did the accountant cross the road?
Why? I don't know. Why?
To bore the people on the other side. Laugh.
Do you have another joke?
I do actually.
Oh my god, tell
this
us.
one's even funnier.
Oh god.
What do you call an accountant seen talking to someone?
An accountant?
I don't know.
Popular.
Oh, I get it. Okay, now back to work. So as you know that this method calculates how the capital assets of a company, and but this method is very unstable. It depreciates the asset based on its level of productivity. For example, a company must first determine a depreciation rate per unit by a number of units it should produce. To determine this depreciation for a given accounting period, the company must multiply the rate by the actual units produced during the period. So basically, high depreciation is charged when there is a high activity, and the less is charged when there is a low operation.
Created using Powtoon.